What's happening in silver markets right now isn't what most people think it is. Everyone's talking about breakouts, technical patterns, and investment opportunities, but they're completely missing the real story. The surge in silver prices isn't a signal to buy precious metals for profit. It's a warning signal from the deepest levels of the financial system that something fundamental is breaking down. I've been watching markets for over 4 decades, and I can tell you that silver doesn't move like this during normal market conditions. Silver is an industrial metal with relatively stable demand patterns. When it starts exhibiting the price behavior we're seeing now, it's telling us that smart money, central banks, and institutional insiders are positioning for systemic breakdown that retail investors don't even know is coming. This isn't about silver's value as an investment. This is about silver's role as a canary in the coal mine of global finance. When silver prices start moving in ways that can't be explained by normal supply and demand fundamentals, it means the financial system itself is under stress that most people can't see yet. The people who understand what this silver surge really means are quietly preparing for economic disruption that will make 2008 look like a minor correction. The people who think this is just another commodity trade are going to be caught completely off guard when the real crisis hits and silver becomes one of the few assets that maintains its value. If you want to understand what the silver market is really telling us about the state of the global economy and how to position yourself for what's coming, you need to subscribe to this channel right now, because the warning signals that silver is sending could save your financial life if you know how to interpret them correctly. Let me start by explaining why silver's recent price action is completely different from normal market dynamics. Under normal conditions, silver prices move based on industrial demand, jewelry demand, mining supply, and investor sentiment. These factors create gradual, predictable price movements that technical analysts can chart and predict with reasonable accuracy. But what we're seeing now is price action driven by forces that have nothing to do with normal silver markets. Central bank buying, sovereign wealth fund accumulation, and institutional positioning that suggests these sophisticated actors know something about future economic conditions that retail investors don't understand. When central banks start buying silver aggressively after decades of focusing exclusively on gold, that's not a coincidence or a diversification strategy. Central banks don't make impulsive decisions about reserve assets. They operate based on analysis and projections that look decades into the future. If they're adding silver to their reserves, it's because they see scenarios where silver becomes critically important for monetary stability. The second unusual factor is the behavior of industrial users who are building silver inventories far beyond their normal consumption needs. Companies that use silver in manufacturing are typically focused on just-in-time inventory management to minimize carrying costs. When they start stockpiling silver beyond immediate production requirements, it suggests they're concerned about future availability or price stability. These industrial buyers have inside information about supply chains, geopolitical risks, and economic trends that affect their businesses. When they collectively decide to build larger silver inventories, they're telling us that they see disruptions coming that could affect silver availability or affordability in the future. The third warning signal is the breakdown of normal relationships between silver prices and other markets. Historically, silver has traded in fairly predictable ratios to gold, copper, and broad commodity indices. When these relationships break down, it usually indicates that silver is responding to forces that don't affect other markets in the same way. Right now, silver is outperforming gold significantly, which is unusual because gold is typically the preferred safe haven asset during times of uncertainty. When silver leads gold, it often means that industrial demand or supply concerns are overwhelming traditional safe haven demand. This suggests that the current crisis has both monetary and economic components that make silver uniquely valuable. The fourth warning signal is the complete failure of paper silver markets to suppress physical silver prices. For years, large banks and hedge funds have used futures contracts and derivatives to influence silver prices despite strong physical demand. The fact that these suppression mechanisms are no longer working effectively suggests that physical demand has become so strong that financial manipulation can't overcome it. This breakdown of price manipulation mechanisms is particularly significant because it indicates that the current silver buying is coming from sources that need physical metal, not just financial exposure. When paper markets lose their ability to set prices for physical commodities, it usually means we're transitioning from financial markets to supply and demand reality. The fifth warning signal is the geographic distribution of silver buying that reveals geopolitical positioning for monetary system changes. Countries that are reducing their dependence on the US dollar are building silver reserves alongside their gold purchases. This suggests they see silver playing a role in alternative monetary systems that bypass dollar-dominated international trade. China, Russia, India, and other countries that are developing alternatives to the Western financial system are treating silver as a strategic resource rather than just a commodity. When major economies start hoarding silver for geopolitical reasons, it tells us that they expect the current monetary system to become unreliable or unavailable for international commerce. The sixth warning signal is the emergence of silver shortages in retail markets despite seemingly adequate mining production. When retail buyers can't obtain physical silver easily or have to pay significant premiums over spot prices, it indicates that available supplies are being absorbed by larger buyers who are removing silver from normal distribution channels. These retail shortages are particularly concerning because they suggest that institutional accumulation is so aggressive that it's overwhelming all available supply sources. When large buyers are willing to absorb all silver production plus existing inventories, it indicates they see scenarios where silver becomes much more valuable or much less available in the future. The seventh and most important warning signal is the timing of this silver surge relative to other economic indicators. Silver isn't moving in isolation. It's rising alongside other crisis indicators like yield curve inversions, bank failures, currency instabilities, and geopolitical tensions. This correlation suggests that silver is responding to the same underlying systemic stresses that are affecting the broader economy. When multiple warning signals flash simultaneously, it usually means that a major crisis is approaching. The fact that silver is confirming what other indicators are suggesting makes the warning much more credible and urgent. Markets can give false signals individually, but when multiple independent indicators point to the same conclusion, it's usually time to pay attention. Now let me decode exactly what crisis the silver market is warning us about, because understanding the specific nature of the threat is crucial for positioning yourself correctly. The silver surge isn't just telling us that economic problems are coming. It's providing a detailed roadmap of how the crisis will unfold and which systems will fail first. The primary warning that silver is sending is about currency system breakdown that will force a return to hard asset backing for international trade and domestic monetary systems. Silver's unique properties as both an industrial metal and a monetary metal make it essential for any economic system that needs to function without fiat currency support. Unlike gold, which is primarily a store of value, silver has essential industrial applications that create baseline demand regardless of its monetary role. This dual utility makes silver more valuable than gold in scenarios where economies need to rebuild from currency collapse because it serves both monetary and productive functions simultaneously. The fact that central banks are adding silver to their reserves after decades of focusing exclusively on gold tells us they're preparing for scenarios where bilateral trade settlements bypass the dollar system entirely. Silver provides smaller denomination monetary units that are practical for everyday commerce, while gold serves as the backing for larger transactions and international settlements. The second warning is about supply chain breakdown that will make silver's industrial applications critically important for maintaining technological infrastructure. The modern economy depends on electronic systems, telecommunications, renewable energy, and medical devices that all require silver as an essential component. When smart money starts hoarding silver beyond normal industrial requirements, they're positioning for scenarios where supply chain disruptions make silver unavailable at any price. The companies and countries that control silver supplies during infrastructure breakdown will have enormous advantages in maintaining operational capabilities, while competitors face material shortages. This supply chain warning is particularly urgent because silver mining is concentrated in politically unstable regions and depends on complex international trade relationships that are already under stress. Mexico, Peru, and China dominate silver production, and any disruption to these sources would create immediate global shortages that no amount of money could solve quickly. The third warning is about monetary system instability that will force governments to restore credibility to their currencies through hard asset backing. The current fiat currency system depends entirely on confidence in government fiscal responsibility and central bank competence. When that confidence breaks down, governments must provide tangible backing to maintain monetary system functionality. Silver provides the perfect solution for monetary system reconstruction because it's abundant enough to back circulating currency while being scarce enough to maintain value. Gold reserves aren't large enough to back the money supplies that modern economies require, but silver supplies could theoretically support currency systems if governments were willing to restore convertibility. The behavior of sovereign wealth funds and central banks suggests they're preparing for exactly this type of monetary system reconstruction. They're accumulating silver not because they expect prices to rise, but because they expect silver to become essential for monetary system credibility when fiat currencies lose acceptability. The fourth warning is about inflation acceleration that will make precious metals essential for preserving purchasing power as paper currencies lose value. But this isn't ordinary inflation that central banks can control through interest rate adjustments. This is systemic inflation caused by currency debasement that requires fundamental changes to monetary systems. Silver's price behavior suggests that institutional buyers expect inflation to overwhelm central bank control mechanisms and force currency devaluations that make paper assets worthless. In hyperinflationary scenarios, silver provides both purchasing power preservation and practical utility for commerce when paper currencies become unacceptable. The historical precedent for silver's role during currency crises provides the template for understanding current market behavior. During previous monetary system breakdowns, silver became the medium of exchange for everyday commerce, while gold served as the ultimate store of value for large transactions and international trade. The fifth warning is about technological warfare and economic sanctions that will disrupt global trade relationships and force countries to develop alternative payment systems. Silver's role in electronics and renewable energy makes it strategically important for countries that need to maintain technological capabilities during international conflicts. Countries that control silver supplies gain significant leverage over nations that depend on technology imports for critical infrastructure. The current geopolitical positioning around silver reserves suggests that major powers are preparing for scenarios where trade relationships break down and resource control becomes a primary source of national power. This technological warfare scenario explains why countries like China and Russia are building silver reserves despite their official dismissal of precious metals as outdated monetary concepts. They understand that controlling critical materials provides strategic advantages during periods of international conflict and economic fragmentation. The sixth warning is about demographic collapse in developed countries that will force governments to choose between currency destruction and social system breakdown. Aging populations with massive unfunded pension and healthcare obligations create mathematical problems that can only be solved through currency debasement or social unrest. Silver positioning suggests that institutional buyers expect governments to choose currency debasement as the lesser evil, leading to monetary systems that require hard asset backing to maintain any credibility. The demographic mathematics are so extreme that no amount of economic growth or productivity improvement can solve the obligations without fundamentally changing how money works. The timing of silver accumulation relative to demographic trends indicates that sophisticated buyers expect the crisis to accelerate within the next few years as baby boom retirements overwhelm government fiscal capacity and force immediate choices between competing priorities. The seventh warning is about environmental and climate policies that will create enormous demand for silver in renewable energy systems, while simultaneously constraining mining capacity through environmental regulations. This creates a supply-demand imbalance that makes silver critically scarce regardless of its monetary properties. Solar panel manufacturing, electric vehicle production, and battery storage systems all require substantial silver inputs that will grow exponentially if governments implement their stated climate policies. At the same time, environmental regulations are making silver mining more expensive and difficult, constraining supply exactly when demand is exploding. The institutional silver buying suggests that smart money understands this supply-demand mathematics and is positioning before the shortage becomes obvious to everyone else. When silver becomes essential for climate transition while being constrained by environmental regulations, prices could rise far beyond current levels simply due to industrial necessity. But the most important warning that silver is sending is about the timeline for these crises to converge and overwhelm existing systems. The urgency of current silver accumulation suggests that institutional buyers expect multiple crisis factors to hit simultaneously rather than unfolding gradually over many years. When central banks, sovereign wealth funds, and major corporations all start hoarding the same assets simultaneously, it indicates they have information about upcoming events that require immediate positioning. The fact that this positioning is happening now suggests that the crisis timeline is much shorter than most people realize. The mathematical reality of debt levels, demographic pressures, currency instabilities, and supply chain vulnerabilities means that the current system can't continue functioning much longer without fundamental changes. Silver's price behavior suggests that the smart money expects those changes to begin within the next 12 to 24 months. Understanding these warning signals is crucial because they provide guidance for positioning yourself before the crisis accelerates beyond the preparation phase. The people who recognize what silver is really telling us and act on that information will be prepared for disruptions that catch everyone else completely off guard. Now that you understand what the silver market is really warning us about, let me tell you exactly how to respond to these signals and position yourself for the systemic breakdown that's coming. Because recognizing the warnings is worthless unless you take decisive action to protect yourself and profit from the opportunities these crises will create. The most important thing to understand is that you're not buying silver as a speculation on higher prices. You're buying silver as insurance against systemic breakdown and as strategic positioning for the new economic reality that will emerge from the current system's collapse. For systemic breakdown insurance, you need physical silver that you can access immediately regardless of banking system functionality or government restrictions. Focus on recognized forms like American silver eagles, Canadian silver maple leafs, and 1-ounce silver rounds stored in secure facilities outside the traditional financial system. I recommend starting with enough silver to cover 6 months of essential living expenses at current prices. This provides crisis insurance that maintains purchasing power regardless of currency instability or banking system problems. But physical silver insurance is just the foundation. The bigger opportunity comes from positioning yourself to benefit from the supply shortages and price appreciation that will result when these warnings become obvious to everyone else. Silver mining stocks provide leveraged exposure to appreciation while offering operational improvements during bull markets. Focus on established miners with low costs, strong balance sheets, and reserves in stable jurisdictions. Companies like First Majestic Silver, Hecla Mining, and Pan American Silver have track records that make them likely survivors of the developing shortage. Avoid speculative junior miners that might not survive economic disruption. Silver ETFs provide convenient exposure, but choose ones backed by physical metal rather than derivative contracts that might not be honored during crisis conditions. The ideal approach combines physical silver for insurance with mining stocks for investment exposure, creating comprehensive positioning that provides both crisis protection and profit potential. International diversification becomes critically important when positioning for systemic breakdown because different countries will be affected differently. Establishing silver positions in multiple jurisdictions protects against confiscation while providing access to markets that might remain functional when domestic markets break down. The timing of your silver positioning is crucial because the window for acquiring silver at reasonable prices is closing rapidly. Institutional accumulation driving current increases will eventually overwhelm available supplies and force prices much higher very quickly. Dollar cost averaging works well for silver accumulation because it eliminates timing risk while ensuring you build meaningful positions before shortages become acute. Invest a fixed amount monthly regardless of current prices. The biggest mistake most people make is treating this like a normal investment where they can wait for better prices or more confirmation. By the time silver shortages become obvious to everyone, prices will already reflect that reality, and insurance benefits will be much more expensive. Understanding the timeline is critical for implementation. The urgency of institutional silver accumulation suggests major crisis events could begin within the next 12 to 18 months. This means you have a very limited window to position yourself before the preparation phase ends and crisis acceleration begins. But don't let urgency lead to panic buying or poor decisions. The people who benefit most from crisis situations are those who prepare systematically and maintain clear thinking when everyone else is emotional and reactive. The key insight is that silver's price surge tells us smart money has already made their decision about future economic conditions. They're not waiting for more evidence or better timing. They're positioning now based on analysis that concludes systemic breakdown is inevitable within a predictable time frame. If you trust the intelligence capabilities of central banks and major institutional investors, then you should follow their lead in silver accumulation while adapting their strategy to your circumstances. The warning signals couldn't be clearer for those who know how to interpret them. If this analysis has convinced you that the silver surge represents a crucial warning about systemic breakdown rather than just an investment opportunity, then share this video with anyone who needs to understand what's really happening. Subscribe to this channel for continued analysis as these signals develop. Leave a comment below and tell me what steps you're taking to respond to these silver warning signals. Are you building physical positions? Are you considering mining investments? The community of people who understand these warnings needs to support each other through the transition that's coming. Remember, the silver market is giving us advance notice of systemic problems that most people won't recognize until it's too late to prepare effectively. The question isn't whether you believe these warnings. The question is whether you're going to act on information that could save your financial future when the current system inevitably breaks down.